And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Tuesday as we kind of get ready now to start earnings, right? So earnings season's about to start next week. And we're going to get through, on Friday. My apologies. I'm a week behind because of the travel. But yeah, starting Friday, we've actually got earnings from JP Morgan, Wells Fargo, et cetera. So we're going to start the bank earnings on Friday. That's going to move into the kind of the mega cap 7, 10, really, the top 10 companies. Those will come about the week after next. So again, we've got a lot of earnings about to start hitting the market. So we'll have something to actually talk about other than just tariffs at the moment. But the buyback window for stocks is now closing. So again, we're having a little bit less participation in the markets right now. It's not a big deal, but it does provide less buyers for the markets temporarily. So we may have a bit of volatility here, a little bit of pickup again with markets very overbought, as we talked about yesterday. A bit of corrections shouldn't be unexpected right now at all. So just kind of be aware of that as we start to move into earnings season. The big thing to really be paying attention to in earnings is not really so much what they report. Guidance has been brought down a lot. So we're going to have a high beat rate for earnings in the second quarter. We're probably going to do 70-75% earnings beats. Revenue beats will be good because we've lowered those estimates so much right now. But what will be worth paying attention to is really what they say about the rest of this year. This tariff flux right now is certainly causing a little bit of concern, but it's not that big of a deal. But what's going to be important to listen to is how these companies are dealing with tariffs. Are they able to pass it on to consumers? Are they having to eat it? What's that going to mean for profit margins going forward? Those are going to be the things to really be paying attention to a lot because again, a lot of the tariff things that just kind of started in the second quarter, so they haven't really been fully reflected into earnings just yet. That'll show up later this year. So again, as we kind of start moving forward on what they say about that, this is going to be the important thing to be paying attention to really for markets. Because again, the only thing that matters, as we said before, is what impacts earnings. So if the market starts to have to lower their expectations for earnings, they're going to have to lower their expectations for forward returns on stocks. That puts weight on the markets. But interestingly enough, right, so back in April, we saw a lot of companies like Goldman Sachs and others, they lowered their year-end estimates. We came into this year with a lot of companies saying, hey, we're going to get to 6,900, 7,000 by the end of the year. When we got into April with that sell-off, all of a sudden those dropped to like 6,200 for the year. And again, so as we start getting closer, and the markets have now rallied back up to 6,200. Not surprisingly, we're now seeing Goldman Sachs and others coming out saying, oh, we're back to 6,900 again. So we're now starting to see all these analysts starting to crank up the expectation, the S&P targets for the end of this year. Again, not surprising with the recent rally we've had in the market so far. But again, that's just kind of again, lots of exuberance in the markets, but the thing to really paying attention to is what earnings are going to look like going forward for the rest of this year, because markets price off earnings. And so if those earnings estimates come down because of concerns about tariffs or slower economic growth, whatever it is, we're going to have to start lowering those S&P targets by the end of the year. So again, just there's a lot of kind of moving pieces over the next couple of weeks that can impact markets. There's a lot of a lot of expectation built into companies like Palantir, et cetera. They've had huge runs. So that bar has really been lifted pretty high for earnings going into this quarter. So again, there's some potential for some disappointment in these stocks. And so there's potential here for some stocks to actually have fairly decent corrections. So just be aware of that as we start to move into next month. As we start, and so kind of back to the economics real quick, from an economic standpoint, the data is okay. It's not fantastic. One thing was we saw that employment report on July the 3rd, which was stronger than expected. However, when you start digging into the ISM services and manufacturing reports, we're seeing those employment components actually drop into contraction territory. So again, while the BLS report was very strong, the underlying kind of more focused real-time indicators are certainly suggesting much weaker employment. And again, that kind of goes back to what we've talked about before in terms of the overall economy. It is slowing down, and that is going to impact earnings. So again, as we focus on earnings over the next couple of weeks, and we're getting all excited because companies are beating earnings estimates, et cetera, pay attention to what they're saying about the future, because I think that's going to be much more important into how the markets actually respond to those earnings reports more than anything else. Okay, let's talk about what you need to know before the bell this morning. We're going to take a quick trip around some different markets here real quick. Yesterday, the market did sell off a little bit. Not surprising. New announcements on tariffs. We talked about that yesterday. Started to work off some of that really overbought condition, but we got a long ways to go on that. So again, a bit more sloppiness here wouldn't be surprising over the next week or so. We just need to work off some of this kind of overbought condition. Got a fairly big deviation between the current level of the market and even the 20-day moving average. There's a fairly decent deviation there, and just particularly above the 50 and the 200-day moving average, that gap has gotten pretty big. So again, just kind of that gravitational pull of moving averages is likely going to pull stock prices down here at some point. Doesn't necessarily mean today, but again, we've got a lot of stuff to work through now with tariffs kind of trying to come back and the earnings, got a lot of other stuff going on. So there is a risk. Be sure and take some profits here, rebalance your portfolio a bit. Would not be a bad idea at this point. 10-year Treasury yields have been rising here over the last couple of days. Lots of headlines trying to assess, like, why are they going back up? Is it the big, beautiful bill? Is it this, that, whatever? No, we have Treasury auctions this week. So as is always the case going into a Treasury auction, particularly for 10s and 30s, what traders do is they basically short the bond market going in. They want to drive yields up, drive bond prices down going into the auction so they can buy those bonds cheaper. So again, we got pretty decently oversold here on yields. And so again, this kind of bounce over the last 4 days going into the auction is not surprising at all. But again, we still have a pretty good trend lower here in yields at this point, particularly as the economy slows down. Would expect that to be the case. Once we get through auctions at the end of this week, likely going to start to see bond buying come back in as well. So again, just don't read a whole lot into short-term movements in yields. They typically don't mean anything, particularly when you're going into an auction. Outside of that, crude oil, of course, has been kind of one of the big stories as of late. We had this huge spike in oil over concerns about Iran, and of course the bombing of Iran that immediately after that completely collapsed, because the threat of World War III quickly dissipated. But oil prices have been kind of creeping up here just a little bit. We're trading right now around $67, $68 a barrel. It has been creeping up very slightly. We got pretty oversold here on a short-term basis, so this reflexive rally in oil is not surprising. But we're coming up to challenge the 200-day moving average. So again, if oil can break above that, we might see some higher oil prices here near term. We are moving into hurricane season as well. So again, there's some threats to oil supplies if we have a big hurricane in the Gulf that shuts down offshore drilling platforms, or if something hits Louisiana as an example, where we have a lot of drilling production, that could provide a short-term boost to oil prices. But again, we're not on a buy signal yet, but getting decently close. So I'm just saying there is some upside in oil prices here, so energy stocks should perform a little bit better in this environment. The skew index is something that's a little bit harder to pay attention to, but the one thing about it, importantly, is that it is telling us right now that, again, not surprisingly, we're seeing a lot of volatility kind of evaporate out of the markets right now as speculation has really returned large ways. Skew has dropped sharply. That's kind of relating to a lot of options activity, but we're seeing that across the VIX as well. So again, no matter how you look at this, a lot of that concern about markets has evaporated here, and that speculative activity has returned very quickly to markets. Again, there's no fear of a correction right now, which is generally a good time to start hedging your portfolio a bit, because that's generally when it happens. But that's what you need to know before the bell this morning. We'll come back, pick up with John Penn, get into why ETFs are actually eating the world. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. John Penn joining me as well.
Good morning.
Rooting for the Stros, are we?
I'm rooting for the home team this morning.
All right. How are we doing this year?
Actually, so
I'm just putting him on the spot here.
last time I
I'm
checked,
just checking.
no.
I'm just
So
checking
here
to
we
see
go.
if he's
So, all
actually
right.
keeping up here.
So right now we're number one in the division.
Yep.
And I think we're third in the league, like third of all the teams. I think we are. I think we're right behind the Dodgers. We're in third place right now.
There you go.
Not too bad.
Nah, not too bad. We'll see if they can pull it off.
We'll see if we can pull it off. It's hard to believe we're going.
One thing about Houston teams, we're awesome about blowing it right at the end.
Well, so
we're really good at that.
And it's hard to believe we're coming up to the All-Star break next weekend, right?
Yep.
So we're already halfway through baseball. But I think it's Detroit, LA, and then Houston. So we're right there.
There you go.
No, well, I'm supporting the home team this morning because I had a little procedure. I had a basal cell carcinoma removed off my head. So I put on the hat this morning just to spare everybody else from having to see what the party that's going on under here. So I appreciate you letting me root for the home team this morning.
No problem. That was probably more information than we
Is
actually
that
needed.
TMI? Did our relationship just go from here to here?
Exactly.
It's called full disclosure.
That's it. We're all about transparency and disclosure, folks.
Exactly. So an interesting article in Barron's. And again, this kind of really feeds into a lot of what we talked about yesterday. Yesterday I showed you that chart here on the show that showed the amount of money going into ETFs, prior 2020. And then, prior to 2020 is about $50 million, dollars a year, whatever, blah, blah, blah. And now it's like $500 million. It's just this huge jump of money. And it's just this massive surge just since 2020. And of course, whenever there's a lot of demand for something, Wall Street is happy to oblige, to provide you more opportunities to invest your capital for their ability to make money off of you. Again, this is a profit game for Wall Street. Wall Street is a massive business. And for some reason, we always think that Wall Street is there to protect our best interests. It's like, oh yeah, we're here for you. UBS has the best tagline ever, right? UBS, it's you and us. No, it's not you and us. It's not you and anybody else. It's us taking advantage of you. That's what UBS does best. But again, whenever you're demanding a lot of something, right, they're going to make sure and provide it for you. So if there's a lot of demand for getting money invested, they're going to certainly come up with very creative ways to provide you opportunities to invest your capital. And this is why there's a huge push right now for getting private equity to be public equity, right? And just get everybody invested in private equity now, which should tell you right up front that there's going to be problems with it down the road. Because again, what makes something valuable is a lack of commonality, right? So if there's a small supply of something, it becomes much more valuable than when it's available to everybody. So again, this is just something to be very careful about. I thought this article was interesting. Just bring me up just grab this headline here. Thought this was interesting. It's ETFs are eating the world, the right and wrong ways to invest. The subline to that title was more than 700 ETFs launched last year. That is a huge number of ETFs to bring to market. And again, each one of those are vying for capital. Now remember, an ETF doesn't work if it has no capital in it. I can, John and I can launch the 2 Deads on Money ETF tomorrow. And if nobody invests in it, we're not going to be in business for very long, right? It takes about 20 to 25 million, $30 million worth of assets under management just to break even on expenses. And that's if you're a very lean shop. Normally it's around 50 million. And you don't really start making money with an ETF until you have 100 million under management. So you just think about last year, there's 700 ETFs that launched last year that need at least $100 million. That's, $7 billion worth of capital just to get those ETFs profitable, which means there's likely going to be a lot of these that are going to fail, they're going to go away, et cetera. So again, just be careful what you invest in. But I think the bigger message, though, John, here is that this is just more of that speculative kind of greed from retail investors that we're seeing. It's just, I got to get my money invested in something. And what worries me about that is normally when you see this type of activity, it usually comes right before you don't want to be doing that kind of activity.
Well, yeah, I mean, if there's an appetite for risk, or if there's an appetite for, even in the ETF space, some more creative ETF type of structures, Wall Street's going to find a way to bring this to the market to satisfy that appetite. Like you mentioned, so last year, 700 new exchange traded funds were introduced. Of those, 33 of them, track, various cryptocurrencies. Mm-hmm. There's also, I think, 130 of those 700, 130 of those ETFs that fall into that kind of that buffered or that hedged space, right, where there's maybe some option strategies built in there to try to help protect on the downside. I think there's a real approach with a lot of these exchange traded funds where it's, hey, we want to give you, the upside of the market without the downside, but there is still downside involved with these. It's not like these ETFs you put your money in and they're a unicorn where you make money and in up markets and you don't have any sort of risk of loss in downside markets. I think that is a very common misconception that I come across, where folks say, well, I want to use these buffered ETFs in my portfolio because they're not going to go down in value. That is not the case. Just look at how, and the challenge with a lot of these new buffered ETFs is they're new. They haven't been around for very long.
Right.
So it's hard to really examine how did these strategies really perform during periods of market stress. The most, what you can do is go back and, look at April earlier this year and how did a lot of these new ETFs hold up then? I mean, there were two for a client just yesterday. I was looking at 2 different buffered ETFs yesterday for a client, and they were down during the peak drawdown in April. They were down anywhere from 12 to 15%. Now markets were down more.
Markets were down 19.
Yeah, markets were down 19. So these also came down. So it's not that these won't come down in value, but some of these are so new. It's really I think folks are having a hard time finding data around how these behave.
Well, and two, one of the problems with these buffered ETFs is that when there was only a couple, that's fine.
Yeah.
They tend to perform okay. But as with anything else, right, the more and more of these that you get out there, then the market starts arbitraging against them. So again, a lot of that, because again, when you're buying, if you're using options to hedge a strategy, whatever it is, the more people that are buying the options, those get arbitraged within the market itself. So the return that you get from that becomes less. It gets what we call arbitraged out of the market, right? So the effectiveness of it goes away the more of these assets you get put in place. But it's not just those ETFs, John. It's also the single stock ETFs.
Yes.
I don't understand single stock ETFs. If you're going to buy NVIDIA, just go buy NVIDIA. Why are you buying an ETF and paying an expense ratio to buy NVIDIA?
Well, because you could potentially these are levered, right?
Yes, they are levered. I can do that with options and save my expense ratio. But I get it, right? I get it, right? But again, this is the creativeness of Wall Street, right? It's like, oh, you want to buy NVIDIA? Well, here's a 2x or a 3x way to buy NVIDIA, and it works great as long as the stock is going up, right? It really sucked being in that back in April when NVIDIA was going down with the markets, and you're down 20%, right? So, because levered, you're down 40, 45, 50, depending on how much leverage you've got in your ETF. But John, this is the kind of the point, though, is that when you really come back and even the article itself is great. It says, core ETFs to consider, right? So here, out of these 700 new ETFs, out of the thousands that are out there, actually right now too, actively managed ETFs have now overtaken passive indexed ETFs in terms of total volume. So people are chasing these. But you go back to which of these should you own? Spiders, the S&P 500, MSCI, EFA ETF, Vanguard Total World Stock Index, the old guard,
old school.
Just buy the passive indexes because you'll do better. And again, it doesn't, all these fancy derivatives, et cetera, are fine. And, again, I get tons of emails on this, John. It's like, oh, I have this ETF and I have this ETF. What do you think about it? They're all fine as long as markets are going up. The risk that you take is that eventually this market cracks for whatever reason. It doesn't seem like right now that's going to be the case. But I can tell you, I have been in markets like this before, like the late 90s and in 2005, 6, and 7. It didn't seem like anything would bust the market. It was just the market would go up, and it didn't matter what the news flow was. Everybody was getting very greedy. And I haven't seen greed like now in the markets. I can't remember a period of time where we had people this greedy about markets other than the very, very late 90s, 97, 98, 99. And when we were trading back then, it was a very, kind of very dynamic market. There wasn't a lot of ETFs. There were like 3 ETFs at the time, Spiders, Diamonds, and Q. So nobody's really talking about those. But it was all about buying .com stocks and getting whatever type of leverage I could get into this. People borrowing on credit cards to, buy more stock in the markets. Again, I haven't seen that type of speculative mentality since then until now, and I'm not saying it's a bad thing at all. It's how markets work, but it's also a warning at the same time. All right, quick break. Come back, pick up with John Penn. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I remember in school those history stories about the late 1800s, and now Gen Z kids are now calling the 90s the late 1900s.
The Real Investment Show podcast.
And I feel like I just drank from the wrong Grail in Indiana Jones.
Same show, your schedule.
I was talking to my daughter a few weeks ago, and I said something that she didn't agree with. And she goes, "Dad, you're just getting old and not relevant anymore."
At realinvestmentadvice.com.
Not relevant.
You're not relevant.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just real quick, I want to finish. I want to talk about the dollar here a little bit, but before we finish, I just want to finish up our conversation on ETFs just for a second. There's a report that comes out every year called the SPIVA report, and it's published, and it reviews mutual fund managers, and it says 80% of fund managers underperformed their index this year. Yeah, that happens. But what's important about investing over time is consistency of returns and managing the risk of drawdowns, those type of things. And while a mutual fund may underperform its index this year or next year, whatever, but it may underperform this year as an example because it's a small cap fund, and small caps are underperforming this year, right? So it's, you're going to have these years where a certain, class is outperforming versus something else, and so there's an underperformance of that fund. But what's important though is to go back and look at returns over long periods of time, cumulative returns over long period of times, and then compare that to, your benchmark index. And what you'll find is funds like, Fidelity Magellan Fund and Fidelity Contra Fund as an example, and there's lots of these Sequoia funds. Over long periods of time, yes, there are years where they underperform their index. Maybe this year, maybe next year, they underperform. But over longer term periods, 10 years, 15 years, etc., they have crushed the underlying S&P index over time because they don't suffer as big of drawdowns. They have years where they outperform, really, really well. But over a long period of time, there's just a massive gap between that mutual fund and the performance of just the index. And so one of the problems with ETFs, and this is kind of the irony of ETFs, is they call, this is a passive index. Well, it's a passive index, yes, because it's just tracking the S&P, but people are trading these things like crazy. So I'm buying the S&P to trade a move in the S&P, and I'm out of it now because the market's going down, whatever. And so they're actively trading these ETFs like stocks, individual stocks, rather than allowing them to work. And again, when you start thinking about buying a passive index, great, you're going to get the return, the average return of the index over time, right? Because you're invested in this index, this ETF. But you're not going to outperform the S&P 500, where you would using an active manager like a mutual fund. And I know mutual funds get a lot of bad rap because it's got a 1.5% fee or whatever to it, right? But if you actually start doing the work, you're going to find out that 1.5% is a small price to pay for the outperformance you get over time and the wealth building that you get over time. So it's just, again, just you can't just take a lot of the media analysis at face value, because there's a lot of this analysis just like, buy ETFs because they have low expense ratios versus mutual funds. Yeah, but am I really getting the value for my invested capital? And look, and it's okay. We have an ETF portfolio. We actively trade ETFs in our portfolio, but we're not passively holding them, right? And I think that's the key difference just to think about is if you're just buying, don't get me wrong. There's absolutely nothing wrong if you're young, you're in your 20s, your 30s, just getting started. I told this to my son while I was there. I told you yesterday, he saved up $10,000 now over the last year and a half, on minimum wage. He's doing great. So it was like, hey, time to go buy an S&P index fund, put that in there, and then never touch it again, right? And just every time you get a paycheck now, start dollar cost averaging into that ETF. They're great for that. And that's a great way to use them to start building a nest egg of financial wealth going into retirement. But most investors don't treat them that way. And they wind up, again, like we're going onto the markets now, taking a lot of excess risk or trading these ETFs rather than using them what they're meant to be used for.
Yeah, I think there's a kind of a get rich quick mentality with these. Mm-hmm. It's like with those, triple levered ETFs. And if you're on the wrong side of that trade, or if you're on the wrong side of that bet, man, it can burn you. Just like look at the the article with Barron's that mentioned this. You look at what the NASDAQ has done this year so far. It's up what is it, about 8.5%, 9% so far for the year. And if you're on the wrong side, if you're using the ProShares 3x short ETF that shorts the NASDAQ, you're actually down a little over 35% for the year. Mm-hmm. So you just have to watch it. It's one of those things where I see too many folks where they're placing too much on that bet, where it's like, well, if this takes off, I really want to hit a home run. I want to get rich overnight. Versus, hey, if you use something like this, it's all about balance. Maybe add a little bit to your portfolio. If it does well, you benefit. But if it doesn't work out as intended, it's not going to derail your overall approach. You look at this, more from that long term. And by the way, 3 months is not long term. I don't know why. It's like, it's been 3 months. It's been a long time. It's like, what?
Seems like forever. These days.
It seems like forever these days. But I really appreciate that your comments, Lance. And you're looking at between mutual funds and exchange traded funds. The exchange traded fund industry now, because ETFs are known for having much more reasonable internal operating expense ratios. Mm-hmm. They have really, caused some change within the mutual fund industry now. So, a lot of those actively managed mutual funds, they're having to bring their fees down to compete with ETFs because they're losing funds.
No, they are. Yeah. The ETF, the flows into ETFs have outpaced the flows into mutual funds, and mutual funds are losing share, but they get a lot of bad rep, and they do. And there's a lot of poor quality mutual funds. Don't get me wrong. They don't perform well. They don't do well, etc. You can list a dozen of them off the top of your head, but don't paint. My whole point is don't paint the whole industry with a singular paintbrush and just say, ETFs are better. That's not the case. And there's a lot of great mutual fund managers out there that are well worth the money that you pay them to manage your fund. So just because it's got 5 letters on it, the whole point is do your homework. Right. And then make sure also, just as we talked about before, just don't take on a lot of excess risk. Again, it's working right now. Excess risk is working great right now. The more risk you take, the more money you're taking. But again, as I was saying in the last segment, I haven't seen an environment like this since the late 90s. And I'm not saying we're about to have a dot-com crash. I'm not saying that at all. But I worry about that because speculation tends to lead to broken markets historically. And we've got a lot of speculation in this market over the last few years. And again, that speculation can last a while. If you go back to the dot-com crash, the dot-com bubble started in 1990. In 1990, 80% of investors were new investors to the markets. In 1995, 80% of all investors were new investors to the market because we were just sucking people into the market. The market's just skyrocketing up every year. Everybody's making money hand over fist. People just couldn't wait to get in. It was a FOMO of missing out on the rush to the dot-com internet era. And so we were just flooding the markets with new money coming in from new people that had never invested before. And then in 5 more years, again, lasted a while, it was over. And a lot of those people never came back to the markets.
So I was back at Schwab during those periods of time during the late 90s when you had the dot-com craze. And I mean,
it's hard to believe that was before the turn of the century.
Right. So
in the late 1900s.
In the good old era, the late 90s. But I was working at the front counter at that time at Schwab and just kind of getting my start. And folks were, there were lines out the door. People could not wait to get accounts open. Any money they had whatsoever.
Yep.
It was all .com. There were people coming up. They had just handfuls of cash, like hard money, and they were like, "I want to put that." And we're like, "Well, we don't take cash. You got to go put that in a check form." I mean, it was nuts.
It was absolutely crazy. And if people don't remember this, but back in that period, day trading was just becoming a real thing because of E-Trade was just coming online, and you had a lot of these day trading firms that were opening up, and people were renting whole buildings, like whole floors of high-rise buildings, just turning them into trading floors and giving people margin accounts to go margin themselves to trade. It was bonkers. I mean, my whole day came in. I'd come in at 8:30 in the morning. I would buy 1,000 shares of SDLI or JDS Uniphase, and the market opened up, it'd be up 80%. We'd sell it and go home for the day. We were done for clients. I mean, it didn't take long to make money for clients. But again, you're just seeing a lot of that return.
Yep.
So not a lot of the companies actually make money and have business plans now versus then. But I'm just talking about the speculative side of it.
Just the emotion around it.
Yeah, the emotion around it. Yeah. Let's talk about the dollar here real quick. John's been getting hit with. Well, here, I'll just let you set us up, and then we'll talk about dollar when we come back.
Yeah, well, I mean, for the year, the dollar's just been on a decline for the year, and it seems like there's a lot of talk around the dollar, and is the dollar still going to be the world reserve currency, or is there going to be a new system, some sort of a new currency or monetary system that replaces the dollar? And it just doesn't help that there's headlines as soon as if the dollar, so the dollar's down this year. Any sort of weakness that it continues to have, it's just like the headlines just keep flowing in, and so it's just that narrative, it's those headlines that just keep pulling people back to the dollar, and just I think what the real question is, they're just concerned about the overall health of the U.S.
Sure.
Right. So getting a lot of questions around that as of late.
Well, we'll come back to talk about the dollar. The rumors of its death are greatly exaggerated, as is always the case, but. We'll take a look at a chart and talk about where the dollar is. Over away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So yeah, one of the a lot of headlines here lately. You know, dollar has biggest first half decline in value since 1973. Right, it just makes it sound absolutely terrible. So we're talking about, you know, the big concern is reserve currency status, right? So is there the big risk that the U.S. will stop being the reserve currency of the world? And that answer is no, it won't. There's no other currency that has liquidity or depth, the rule of law, etc., that people will want to store reserves in. And that's a key fact of what drives the dollar. And yes, has the dollar lost some of its position within global trade? Yeah, and as other countries have grown, as you know, China has grown and become a larger constituent in the global economy, its percentage share of trade in yuan, as an example, has gained traction. That's just because of the size of the country now and the size of the economy because it's grown. So, but, you know, here's a chart. Bring up this chart for me, Brent. But here's a chart of currency composition, right? So 59% of all trade still goes through the U.S. dollar. You know, the euro's come up a bit since it was implemented as well, which also that implementation of the euro also detracted some of the trade from the U.S. dollar as countries within the Eurozone traded with each other within the euro. So they didn't need the dollar for that. But again, when there's when you need to store your reserve currency to balance trade, it's in U.S. dollars. So that's not going anywhere anytime soon, and that's not going to change. But importantly, you know, what we're talking about is this decline. This is huge decline that we're having in the dollar. And so here's a chart of the dollar going back 10 years. This is a monthly chart. And you can see that dollar decline this year has been fairly sharp. Of course, it's also, we saw a similar decline back in 2022, you know, after that huge rally in the dollar. And of course, you know, back in 2021, this was the Russia, you know, Ukraine invasion, and the dollar had declined and going into 2021. And there was all these articles being written about the loss of the reserve currency status, de-dollarization, et cetera. And then you had this massive rally in the dollar that came after that. But what you'll notice is that, step back from all the narratives, right? Because as is always the case, the media has to apply a narrative to some things. Like, why is this happening? Well, here's why that's happening. And that's not necessarily the case at all. It has a lot to do with the fact that the dollar, leave that chart up for a minute, Brent. A lot of it has to do with the fact that the dollar got really overbought relative to the currencies. If you look at the top of that chart and even at the bottom, you'll notice that rally in the dollar in 2021 got to extreme overbought conditions. Well, when that rally occurs, it becomes overvalued relative to other currencies, and that impairs the trade between countries. It makes things too expensive for them to buy because of the dollar. I can tell you, just last week, I was in the UK, and because of this decline in the dollar, right, I went to, I changed my $50 US bill and I got $26 worth of pounds, right? I was like, that sucks. But, that's what's happening right now. So it's making things for me more expensive in the UK. To buy things from the UK is more expensive because of the decline in the dollar. So, but again, that impairs trade. Leave the chart up. I'm not done with it yet, Brent. That impairs that trade. But is this current decline anything other than just a working off of these previously overbought stretch conditions? And so if we go back 50 years in this chart, same chart, just going back 50 years, what we find out is that when we get to these levels that are extremely overbought, right, you consistently have these sell-offs in the dollar. We saw it back in the late 80s. We had this huge rally in the dollar. So again, what was the headline article? It was the U.S. dollar tumbles 10.7% against its peers in June, making the first worst half since 73. Right? What was going on in 1973? We had big surge in inflation. We had a collapsing stock market, right? So who wants to be in the dollar when the stock market's going through the beginning of a major bear market, 73, 74? But 79, 80, you had this massive rally in the dollar. Well, what happened? Did everybody just decide that the dollar's the place to be and to come rushing back in? Well, the dollar got very oversold. Again, an imbalance. And you see this every time it occurs. Every time you get to deep oversold conditions, you're going to get a rally in the dollar. And that's where we are now. But here's the more important thing. Take a look at the chart just from 2008 to present. Right? It's an uptrend in the dollar. The dollar's gaining ground relative to other currencies since 2008. Yes, you've had a bit of a pullback, but those pullbacks are not uncommon. We've seen that repeatedly during this entire trend. So again, what's important about this is to keep things in perspective and not just take a temporary move in the dollar and say, oh my gosh, this is the beginning of the end. It's great for bear porn. It's great for people trying to sell stuff, right, to you that you don't necessarily need. But again, we had this exact same conversation in 2021, and then you had a huge rally in the dollar. The dollar is so oversold right now that we are very likely going to see a fairly sharp increase in the dollar. And if you take a look at the short positioning against the dollar right now, Brandon, this chart, we have the largest short position in the dollar since 2005. And again, when did that rally start? 2008. So again, it doesn't mean it will happen right now, but you've got such a negative bias on the dollar right now, both technically and fundamentally, that you are almost assured that at some point you're going to start getting a rally in the dollar as reserve currencies start coming back in to either chase the stock market, buy the bond market, whatever it is. You're going to see that money return back to the U.S. and you'll see the dollar rally. But again, just be careful with, as we go on this show a lot, just be careful with narratives.
Yeah, I mean, there's a lot of narratives out there right now that are saying that other countries, foreign countries, they're not buying the U.S. They're not buying U.S. Treasuries. That's a very common question, very common concern that I get,
and that's not true, by the way.
It's not true. There's a great chart that as when I have those conversations, I pull this up. Happy to email it. It's directly from the Treasury. It looks back on the last 12 months. The most recent one that I looked at, it goes from April of 2024 through April of 2025, and just even during that 12-month period, you look at all of the countries as a conglomerate: Japan, the United Kingdom, China, Canada, France, Switzerland, et cetera. The net new purchases of U.S. Treasuries has been $977 billion. So they are foreign countries are still buying our Treasuries. So when you see narratives out there that say the difference, or say something different than that, you just need to kind of reach out to a trusted source just to see, hey, is this even something that I need to be concerned about? Is this even real?
Yeah, and remember that most of the people writing these articles, I was listening to this girl talking about, Adam interviewed her, and she's this kind of millennial money person, right?
Yeah.
No experience in actually managing money at all. But all she does is just regurgitate talking points from the mainstream media. And who are the people writing in the mainstream media? They're just journalists. They're not economists. They're not investors. They're not capital managers. They're not any of this. They're just people trying to write a headline. So they're going to ChatGPT saying, I need, write me an article about this. And then they publish that. And then people pick that up, that talking point. And again, there's just so much false narratives that get generated from that because they're trying to apply a reason for why something's happening. And a lot of times that reason has nothing to do with why something's happening at all.
Yeah, and sometimes I'll hear, well, look at the demise of the dollar. I'm just going to get out of the U.S. markets. I'm going to get out of U.S. stocks altogether. And you got to realize that a lot of companies that are in the Standard & Poor's 500 index, they earn revenue from all over the world. I think 40% of the revenue that the companies earn in the Standard & Poor's 500 index come from international sales. So if we do have a weaker dollar right now, it does make U.S. exports cheaper. Right. So that's another thing they have to kind of take into consideration, too, where, you've got the weaker dollar, you've got the headlines here, but it does make exports, for those businesses more attractive to international buyers. So even if it's a weaker dollar, there's still revenue being earned by these companies that are really based out of the U.S.
Yeah, exactly. So anyway, but that, as we wrap up the show, just as is always the case, be careful of narratives, particularly when you read something, and this is the problem right now, there's so many of these kind of bearish narratives running around, and they're just trying to, fill space, whatever it is, trying to get clicks or views. And look, bearish clicks and views, bearish headlines get more clicks and views, right? Because it feeds on that natural fear that we have as investors. It's like, oh my gosh, I don't want to lose my money. I better read this article. And then they look, when it's time to be bearish, I will be bearish. Trust me. I will write very bearish articles. I will tell you the reasons why to be bearish. We're not there right now. I have lots of concerns because of all the speculative excess that's going on in the markets right now. That never ends well. But again, it could be years from now, as we saw in the late 90s, before it actually comes to its kind of final head. But there's going to be a lot of devastation financially at some point for retail investors who are taking on this kind of gambling mentality with the markets. You treat the house, if you treat the market like a casino, it's going to treat you like a casino. It's going to wind up taking all your money. The house always wins. But just be careful of these narratives right now because, again, it's great for getting clicks and views, but it's terrible for managing your money. By focus on what matters right now. Focus on technical trends. Focus on fundamentals. Focus on momentum. That's what we need to focus on right now with managing our money and be aware of the risk. Make sure, and as we said earlier, with markets overbought right now, it's stretched, do a little bit of profit taking, do a little bit of gardening in your portfolio, right? You'll be fine. It'll be good. All right, John, thanks so much.
Yep.
Wear a different hat next week.
Will do.
All right, cool. Have a great day, y'all. We will see y'all back here tomorrow. Get by the website, realinvestmentadvice.com. Get signed up for our upcoming Candy Coffee, as well as make sure to get to our Substack at Lance Roberts on Substack and on Twitter, where you can watch our shows, get all our latest articles and more. We'll see you back here tomorrow.